Hello and welcome to the Switzer Daily update. And yesterday, while we're having Australia Day, we had to react to Tuesday's inflation number. It wasn't a good number. And as a consequence, economists are now thinking the interest rate rises that lie ahead will be more than what we were expecting before that inflation number. Before that number, we thought there was possibly one more rate rise or maybe no more rate rises, but now economists are telling us they're expecting possibly 3 more increases. And that's because the inflation rate is now 7.8%, higher than was expected. And you've got the pressure from the unions now for a minimum wage increase to kind of match that inflation rate. In the 1980s, home loan rates went to 17%, partly because of a wage price spiral where unions would get a pay rise and business owners would pass on the wage cost increases via higher prices. Now, the Australian Bureau of Statistics tells us today that the minimum wage increases were starting to feed into some prices, as inflation has jumped to 1.9% in the December quarter, which is nearly a 33-year high. What they pointed out was parts of the pricing index where there's meals out and takeaway food, the prices there rose by 2.1%. Now, the people who work in those sorts of industries were beneficiaries of the last minimum pay rise, which was quite substantial. The fear now is if they get another big one, it will once again feed into inflation and keep inflation high, and that therefore means interest rates will remain high and could go a lot higher than expected. So what the RBA talks about next week when they start considering, or the week after when they start considering what they're going to do with interest rates, all this is going to feed into it. Higher inflation, expectations of the unions asking for higher wage increases, all this could really affect what happens to the cash rate. It's now 3.15%. The CBA thought it would top out at 3.35%. But if the talk is right that there's 3 more 0.25% increases, we're getting up close to 4%, aren't we? So stocks during the regular trading in the US overnight did pretty well. The fourth quarter gross domestic report in the US came in better than expected, which means that despite the Federal Reserve raising interest rates very aggressively, the US may well have a soft landing, a mild recession, maybe even not a recession. But then that puts the pressure on the Federal Reserve about what it's going to do with interest rates. And I think at the moment, both the RBA here and the Federal Reserve in the US are going to have a very big impact on the stock market. The stock market's really positive at the moment. Overnight, the Dow was up 205 points, the S&P 500 up 44 points, the Nasdaq up 199 points, and that's 1.76% increase in one day. And what's also interesting is that Tesla reported better than expected. At the moment, there's a thought that tech stocks are going to take a long time to rebound. If these big tech companies keep reporting better than expected, the market will really like it, and it will reinforce my view that 2023 is going to be a good year for stocks, though we have to watch what the Federal Reserve Bank and the RBA does, because they could have a short-term negative impact on stocks. But if that happens, I think I'll probably turn around and say to you guys, this is a buying opportunity, provided you can wait till later in the year when the good news will start really rolling in for both the economy, inflation-wise, interest rate-wise, and then the stock market. That's still out there waiting to happen. Fingers crossed the RBA and the Fed don't get too aggressive when next they meet and then communicate with us. That's the update for today. Thanks for joining us. See you on Monday.